Relative to what it's done over the last 10 years, it already has become far more volatile. I mean, we've covered $100 days here. 1 day, $100, sometimes 200, okay? So its volatility is off the page now too, relative to its normal behavior, and it'll stay that way, though it will lag what silver does in terms of upward dynamics.
Global financial system as a long line of dominoes. Some are big, some are small. You know, at first they're all standing upright and they're all connected. What is happening in the metals market right now is a problem. It is the first big domino. And remember, we've been talking now for over a year about the transition from the paper markets controlling the prices to the physical markets. What we're talking about here, because people are going crazy. There's so much volatility in those spot gold and silver contracts. They are contracts. The physical markets do not move that fast.
If this were 6 months into the move, and if silver had reached $400 or $500 or something like that, I think you would have a sharp correction from there, but not back to $50. The old reality's gone. The question now is, where is silver going to define the extreme upper end of the new reality? And I think it's going to do it very rapidly, meaning in a handful of months, not 3 years. And I think once it does, it'll probably overshoot and probably collapse from there. If you got in at $400 or $500. The issue is, did you get in at a proper time? And I think happens to be right now is the proper time. You've got to pull back, use the opportunity. And most of our measurements are fairly long-term when we analyze markets. We're looking for the big moves. But even when we get down to the micro stuff like daily momentum or weekly momentum, which we included in our weekend report, when we analyze that, we can even see buy trigger levels, of which, like daily momentum today, is already crossing a buy trigger level. Short-term momentum saying, hey, I'm out of the hole now, okay? The weekly offers a number about $6 above today's high. If you get there this week, next week, that'll adjust down some. So even the short-term stuff is saying, hey, I'm out of the hole, okay? So at that point, I would say, if you're not in silver, join in. Yeah, you're buying it off the low, recent low, but you're buying it well below the recent high. So view it as an opportunity. Nothing has broken other than public sentiment. And I argue that the drop you saw then in 1980, for example, yes, that was top of the old range. Silver just gone from like, what, $5 to 50. And it had a four-fold move in the last 5 months of that explosion. I'm talking 2 quarters roughly. In 2010 and 11, it was a 7-month explosion, which doubled in half the price of silver in 7 months. Both of those surge events, still caught in that old range though, were triggered by the spread breakout of silver versus gold, where you could plot the relative performance chart and you could draw a line with a crayon and say, if you get above that line, you're breaking out over a multi-year base. And when it did, it had a tantrum. We did the same thing, except even a bigger and clearer base, silver relative to gold, at the close of November. So it's only 2 months and 2 weeks now into a likely couple quarter surge. Relative to what it's done over the last 10 years, it already has become far more volatile. I mean, we've covered $100 days here. 1 day, $100, sometimes 200, okay? So its volatility is off the page now too, relative to its normal behavior. And it'll stay that way, though it will lag what silver does in terms of upward dynamics. And I do think that, while gold has a 3,000-year tradition as money, so does silver. Okay, and even India is remonetized silver, allowed in bank transactions and all kinds of things. So it's not like it's a lost idea. Most people see silver as the industrial quote precious metal. It is in fact a monetary metal, has been for thousands of years, and it's being reborn because it's vastly underpriced relative to the mama monetary metal. We had been anticipating a collapse in Bitcoin months ago. And after that November, or I think it was October or November high, it started to drop. And at a price, we had two sell triggers arguing for a massive collapse. These were not minor sell triggers. One was at 107, one was at 102 area, okay, 102,000. When we hit those, we dropped immediately down to the low 80,000s. Spent a couple months trying to hold there, which we'd expected as well, a midpoint pause, we called it. Not a buy, but just a pause, up and down, futile rallies. And then we broke through that 82,000, a week or so ago, and our target stated months ago was 60,000. No, excuse me, let me define that better. Our minimum target was stated as 60,000. We were saying that when Bitcoin was well above 100. Well, the low the other day was $60,005. Okay, so we hit our minimum target and we did it in a crash-like mode, actually two crash-type events. Any rally right now, I think up to the 75, 76,000 zone is probably a sale. The rally will not hold. And I don't think ultimately 60,000 will hold. And Ethereum, which a lot of people thought, well, that's different from Bitcoin. We argued, nope, this little crypto beast compared to Bitcoin in terms of size of the crypto market, we said Ethereum will follow Bitcoin. And it not only followed it, but did worse on the downside. In fact, Ethereum price levels we saw low last week were basically at the lows of the last 5 years. So anybody got in Ethereum over the past decade is wiped out. Okay. I would not be surprised to see much, much lower prices. And I wouldn't even be surprised to see it become almost non-existent. Already sentiment has been crushed. For some reason, people are surprised by it. Our momentum technicals told us, nope, it's got crash potential. When we looked at a price chart of Bitcoin over the last couple of years, it was a layered advance with a pullback and then another surge and then finally that third surge. When you looked at momentum, long-term momentum, you didn't see this upside. You saw a floor. Same level, hit, hit, hit. Whereas price was ascending, momentum was building a floor, like the bridge over the River Kwai, okay? And it went through at 107 and 100, just below 102,000 back a couple months ago. And that's when the crash started. So anyway, I think the vision that it is the alternative money and a competitor to gold and silver is now been crushed. And I would not be surprised to see some financial consequences, meaning companies that weren't 5 years ago anything to do with crypto suddenly got up to their hips in crypto one way or another, and therefore they're vulnerable. Meaning you could get some headlines out of companies that you don't even correlate to crypto having problems or losses that they wouldn't have otherwise had. So anyway, I think it's a bubble burst, and I don't know where it's going to go.
Global financial system as a long line of dominoes. Some are big, some are small. At first they're all standing upright and they're all connected. What is happening in the metals market right now is a problem. It is the first big domino. And remember, we've been talking now for over a year about the transition from the paper markets controlling the prices to the physical markets. What we're talking about here, because people are going crazy. There's so much volatility in those spot gold and silver contracts. They are contracts. The physical markets do not move that fast. But look at this. This is a trader who made billions on gold contracts, suddenly betting against silver, meaning selling it short. That's not a casual move. That's a heavyweight leaning in, using the leverage of the paper contracts. And when someone with that kind of track record shifts their position, it's going to matter. And it's because they can feel the instability and they sense the wobble. They know that the dominoes are closer to falling than anyone wants to admit. And remember, silver is the fuse. It straddles both worlds, so it's a lot more volatile. But this trader, he's not reacting to physical silver. These physical markets, they just do not move that fast. He's reacting to the paper market, a leverage contract stacked so high that they're swaying. That's what we're seeing right now. It's really so interesting. And you know, when one big domino tips over, it doesn't fall alone. This shows you what happens when the pressure spreads from a single trader to an entire government's central counterparty intervention. They had to, because it threatened the entire very fragile paper system. It's political weight, because when a government steps in, especially one as large and influential as China, it means that the position is big enough and the leverage is heavy enough that it threatens total stability in all the markets. This isn't about ounces of silver. It's about those contracts. Short, hello, see, she wanted to come in and see it. Hi, baby. But shorts are selling something that you don't own, and then you anticipate that pushing down the price so you can go in and buy it cheaper, and then you earn that difference between what you sold it at and what you go in and buy it at. But what I really want you to understand as well is a lot of this are naked shorts. So where a short position, you might be short against the box, it's called, against the box, meaning he's got the physical silver over here, but he shorts the paper contracts. That means that if you had to, you could go in and deliver that out. But this position was so large that this was considered a naked short, which means there's no silver that can be delivered. This is huge because, again, once a government intervenes in a short position, it tells you that the paper side has grown too large relative to the real metal underneath. Now the dominoes, they're leaning harder and they're leaning faster. And frankly, they're leaning in one direction. So let me show you, because once political weight hits the line, well, then what is it? The next domino begins to lean, and that's the gold contracts. Contracts. Let's look at how that paper market is tilting the biggest piece in the chain. Let's see. Oh, spot gold. This is a spot gold contract. Okay. What I also want to show you in here are the technical moves, because on 2/6 we were at 49. So I just did this. What's today? Today's the 10th. Okay, so this is, I pulled from Friday, and you can see that big, huge correction. Now, I want to remind you, first of all, that the distance from that 50-day moving average that we've been talking about now for quite some time is 9.45. 10% is a lot. So it's still a lot away above that 50-day moving average. But the 200-day moving average is still 37.38% away. That is extreme. That is showing a massive divergence from its long-term trend. It's not spot gold drifting higher. It's tilting, it's leaning far above that 200-day moving average. And that kind of move doesn't come from the physical part of the buying, though we are, and I cannot wait until it's complete, but it's not complete yet. That transition from the paper markets dictating the visible price to those physical markets dictating the true supply and demand price. What you're looking at in the paper market are futures, options, swaps, unallocated accounts. You're looking at shorts and naked shorts and all sorts of things. Leverage, leverage, leverage. And leverage means you got a teeny weeny bit of equity and lots of debt on top of it that can topple the whole entire system. Remember, 2019, I don't know exactly where it is today, but according to the Bank for International Settlements, for every 1 physical ounce of gold in any form that existed, there were 64,000 ounces of digital gold. And that was 2019, before the party really started. So keep that in mind, because when gold stretches this far above its trend line, it's not because the physical market is tight. It's because the paper market is unstable. The contracts are wobbling. The leverage is swaying. And gold, spot gold, the biggest domino in the line, because it's a paper contract, it's starting to lean. And there's your volatility. It does not mean that it is overvalued. Nothing goes straight up. Nothing goes straight down. You get bouncing along the way. And I've shown you this before. Markets can stay irrational a lot longer than you would ever think possible. But they can. However, they could just be staying in this range, giving that 200-day moving average a chance to catch up. That's the technical part of it.